Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading weekend in June 9th, 2023. I'm Preston Brent. Thanks for tuning in. Well, my theme for this week is Give Me Breath, and that's kind of what we saw. So let's take a look at where we were this past week and what we have coming up, and then we'll jump into the charts, just give you an idea of what I'm thinking here. If we look at the week, you can see everybody was in the green. Some barely. The Russell's really kind of outperforming. So modestly higher for the week. Kind of subdued trading, really, ahead of the Fed's policy meeting and rate announcement next Wednesday. The really notable exception, or what was notable for this past week, was the S&P 500 moving officially into bull market territory, which means it moved up 20% off of its lows made last October, kind of in the middle of October. That's over 248 days in a bear market, which was the longest bear market we've seen since 1948, believe it or not. It doesn't seem like it, but it was. From length, not to the time or to the percentage down, but to the duration of the bear market. Also notable that we did have broadening market gains. That's what I meant by give me breath for the week. What we see is a small cap index, which fell in May over 2%, while NASDAQ was up over 8%. We've kind of seen this flip so far in month to date in June. Small caps up about 8%, while NASDAQ's about flat for the month of June. So NASDAQ's resting a little bit, but the market's been able to cut a little bit of a positive path, even with tech running flat after the huge gains we've seen thus far this year. But the net effect of this, as I said, is a little bit of a broadening market rally. You can see where everybody is year to date. You can see the best performer for the week. Discretionary staples bringing up the rear. Technology is leading the pack for the year, and energy is coming in last for the year. Almost completely flipped from 2022. See the forward PE ratio sitting at 1952, depending on how you do the calculation, but I still think it's higher than it should be. 10-year Treasury closed out the week at 3.74%. Dividend yield in the S&P 1.62, but the earnings yield for the S&P is at 5.16%. Okay, the real yield is positive, which means we're higher than the inflation rate, the headline CPI at 4.9. And then the VIX, we actually moved down sub 14 to close out the week at 1383. Prior weeks at 1442. So it's down a little over 4% this week. We haven't been this low since February pre-pandemic 2020. So all in all, things seem surprisingly calm with a lot of potential pitfalls sitting in front of us, right? I mean, we've got the light calendar this past week. We did see the Institute for Supply Management gauge of prices paid for services kind of moderated to its lowest level since May of 2020. All right, the service sector fell to 50.3. So showing a little bit of stalled growth for the economy, which is kind of where we're seeing all over really globally. Meanwhile, the longer-term treasury yields rose just a little bit. There's going to be speculation on, and I've talked to our members about this too, on how the markets are going to react to a flood of new short-term T-bills that are going to be issued now that this federal debt ceiling has been raised. The Fed's going to rush out there and issue about $600 billion over the next 90 days, but up to $1 trillion through the remaining part of this year. So how's that going to affect the rates? My bet is it's going to raise the rates, and we're going to see how that works its way out, right? But currently for next week, there's a 72% chance Fed Fund Futures is saying that Feds will stand pat on leaving their current interest rate range at 5 to 5.25%. The meeting's next Wednesday, June 14th. But there's more than a 60% probability that they will hike again in July. So there's a lot of mixed signals running around out there. And any one of these hikes or how inflation reacts, because we do get CPI headline and core inflation next Tuesday before the Fed meeting on Wednesday the 14th. So it's going to be very interesting to see how all of this shakes out. And just one twist or turn in inflation or the Feds can knock another 3 or 4% off the markets very quickly. Okay. If we go over to Europe and the Asian markets. But let's look at Europe first. You can see everybody was just barely in the red for the week, still strong year to date. The FTSE bringing up the rear in Europe at 1.48% year to date. But they've got, just like we have our June 14th Fed meeting, they're going to be meeting next Thursday, June 15th, I believe. And the forecast is for them to raise their rates another 25 basis points. So we're going to see how that really shakes itself out over in Europe. But we're getting signals from the ECB that they're going to do probably 2 more rate hikes. And we'll see how that plays itself out with the European markets, although they officially entered into a bear market where they were underwater, negative GDP growth in Q4 of last year and Q1 of this year with a final revision. So remember, the U.S. markets were officially in a negative. Well, we had 2 back-to-back quarters of negative GDP, but the issuing body that says whether we're in a recession or not did not come out and say we were in a recession, primarily because we had very strong, tight labor market and a few other things. So they didn't line up very nicely. But most people, if you look at surveys, feel they're in a recession right now. So that's what's going on over in Europe. You can see the data on there. Meanwhile, euro inflation is at the 4.1%. And that is still fairly high. The ECB, just like the Feds, they want to get the rates down to 2%. So they're going to be a little bit more aggressive because, unlike the Feds, they have not hiked their rates 4 meetings in a row, 75 basis points like the U.S. Fed did. So that's part of the reason why the Feds are going to be pausing next week to give the markets a chance to digest this. But I do believe, like some folks, they're probably going to be forced to raise the rates again, but some believe they're just going to pause. But I don't see at all a shot at cutting the rates. Now, that's what the bond market is saying. They're going to almost over a 90% chance the Feds are going to be forced to cut rates at least 25 bips in the fourth quarter of this year. I don't see it yet, but we'll see how that shakes itself up. Okay. Meanwhile, if we look at the Asian markets, we'll start with Japan. You can see their economy grew more than estimated in Q1 of this year. Okay. Their GDP came in at an annualized 2.7%, which is really strong for the Nikkei. And you can see, look at them year to date, they're up 23.65%, 2.35% for the week. That is unheard of for the Nikkei. They don't normally move like that. Okay. So they're doing very strong. And members, there will be an opportunity for us in the end, I promise. It's going to be a great trade, but just not yet. Meanwhile, if we look at the Chinese markets and Hang Seng, which is Hong Kong, both of them are in the green. China just barely, but China, their equities are mixed a little bit. Their latest inflation data increased concerns that the country's faltering after their post-pandemic recovery. Remember, they came out of it in December. The PPI there fell worse than expected, and they're below 50. And it's showing a very weak reading across all fronts. All right. In addition, on a trade front, which kind of showcases the slowing global demand, Chinese exports fell 7.5% in May, and their imports shrank 4.5%. So consumer spending is not as good as they'd like to see either. So when China slows down and catches a cold, I like to say it's not a canary in the coal mine. It could be a potential flock of canaries in the coal mine. So we got to watch the data coming out of China very carefully. There's one school of thought that says the markets are going to come down and we're going to see a recession at the end of this year. And there's another school of thought that says, no, it's going to be soft, if at all. And we're going to grow and we're going to see a continued bullish run off of the October lows of last year. But a lot of those two scenarios, which are almost diametrically opposed to each other, depend on where inflation goes. And I believe it's going down. But more importantly, it depends on how the Feds react to what inflation does. And if the Feds end up keeping their rates higher for longer or even raise their rates, it's going to knock another 3 to 5% off the markets on where we are now, possibly up to 6 or 7%, depending on, just how their policy statement reads and what Boom Boom Powell does in his press conference. So that's a little bit about what we're seeing here. I'm going to show you the charts here real quick. I'm going to move a couple things around on the screen here, and let's get you over to this screen here. It's going to take about 15 seconds to come up on your screen, so it'll go blank for a second. But what I'm going to take you to is the E-mini S&P 500 futures. And when you look at it, you're going to see a gap up on the right-hand side, right? It gapped up a lot. And all that is a switch over to the September futures contracts, okay? And that gap up is also reflected in the Thinkorswim platform and most platforms. But the SPX, which is a cash index, is not obviously at that level. It doesn't reflect this. Normally, when you roll out at quarter end, because we're coming up on quarter end now, so a lot of platforms automatically roll it over at least a week or two before the actual date. Thinkorswim, TD Ameritrade does that. Interactive brokers, I think you got to select the exact date to have that work. But if you look at the signal application, it reads that and it also rolls it over, which is why we got that gap up. Okay. But you can see here intraday high 12.96% on June 9th. So, and you can see these colored bars here just showing the increased move. I do believe because we're in an Elliott Wave 5, we should expect some softening of price and a little bit of a pullback. And if I were to kind of highlight a little bit of an area where a natural support point would be would be around the 4,300 area. Okay. And if we look at the SPX, you'll see that's just about where it's sitting right now. So I'm gonna find the SPX on here. Let's see, where'd you go? Here we go, right here. If we look at the SPX, you can see here it's at a 43.22 high, but the SPX, it closed Friday at 42.98, right at the 4,300. That is a very tough, hard resistance point. And I think we're going to chop around a little bit. We're not going to get a lot of elevation. In order to get escape velocity to get north of here, we're going to need to see good inflation numbers and a positive Fed policy statement, as well as a dovish, neutral to dovish press conference at 2:30 Eastern time on Wednesday. Boom Boom Powell typically will probably do that, so I think it may add to the move higher. But I do see us having a little bit of a dip as we go through the end of June into July. And then I think we'll have another run until going out to September timeframe. That's the way the charts are looking right now. Okay, but keep in mind the breadth. Remember, I mentioned to you that we did get a little bit of participation in the small cap. So if we look at, I'm going to show you a ratio of the equal weight SPX to the normal SPX. And you can see here right around the beginning of June, we've seen this turn up. Now this ratio's the equal weight against the normal SPX. So when it's moving up, we're seeing breadth expand just a little bit, okay? Which is a good thing, but it's way off the mark because over 70% of the gains this year in the S&P, 77% I think more accurately said, is accounted for just about 7 stocks. Now I can add a couple more in there and that gets me over 85%. And that does not last, guys. If those companies that are leading the way, the FANG index and a few other stocks are leading the way, and then they start to falter, if the rest of the stocks don't pick it up, the market's going to come down. And you can see here, because this is turning up, that gives us a little bit of positive optimism that the other markets, the small cap and others, will move up. So if we come over and we look at a classic example, let's just look at the Russell, okay? If we look at the Russell, look at how the Russell back on June 1st was in the red. And look at how long it's been in the red, in and out, almost, going all the way back to March. But on June 1st, it's just taken off, okay? So we're back into the green again. Not a lot, right? As I said, we're in the green with the Russell about 3.6%, a little over 3.6%. Well, for year to date. and we're coming up on the halfway point of the year. So not a lot, but we've seen a little bit of that rotation, which is increasing breadth, meaning more stocks are participating in this move higher. That's a good sign. We want to see that, but it's done this before, so we need to see a little bit of escape velocity on all these stocks, primarily these smaller cap, and see how they play itself out. If we look and just isolate the equal weight SPX, right, and we don't spend any time on anything else, let me see if I can find it in here. And here we go, right here. So we look at the equal weight SPX. You can see here, like the Russell, it's just barely in the green. And it was in the red on June 1st. And at the beginning of June, it was like someone hit the starter gun, and then the breadth started to expand across other companies in the S&P. That's a good sign, guys. So that's a little bit about what we're seeing right now and what I'm seeing. Now, if we come over and look at NASDAQ, obviously it's to the moon. NASDAQ 100, about 50% of that is accounted for just by the FANG stocks, right? Intraday, it was up 34.64% on Friday. So like the S&P E-mini futures, it hit its high for the year this past Friday, right? And if we look at the Dow has been lagging just like the Russell, all right? And let me just find the Dow on here. I know it's around here somewhere. But here we go. If we look at the Dow futures, you can see in the Dow futures, just like the Russell, it's moved up. It was in the red again on June 1st. So something fired off with the new month of June with breadth increasing. And that's always a good sign in a market when you're being led by just a few of the big stocks. You need more breadth to really maintain that level. So now the key post-Fed meeting on Wednesday is, are we going to maintain this, and will breadth expand to more companies and we'll see more upside participation? If not, we're going to see all of this go away and we'll wind up back choppy to slightly down again. Okay. And if we look at the FANG index, you can see here with FANGs, you see where this is, it hit its high not on Friday, but back here on June 5th. But it's been kind of moving down over the past week. So when we have the FANGs moving down, which account for 20 some odd percent of the S&P and over 50% of the NASDAQ 100 futures and of the S&P 500, you know, a huge weighting of these stocks. When you see this moving down, but we do see the stocks finishing in the green and the S&P in the green, that means other companies have to step up and pick up the slack, and that's a good thing, right? So that's a little bit about what I'm seeing here. And then if we look at the volatility, like I mentioned before, the VIX is now closing in the green. The green is a comfort zone for the markets. And if I back it out, let's just go way out in time. And you can see the last time we closed in the green, okay? And this is a daily chart, but I'm going to scrunch it up. It was way over here on the left-hand side of the screen, and that was on February 14th, 2020, right? And then within 3 weeks, we were up at 83. That shows you how fast the VIX can move. Let me just scrunch it down a little bit more. We're up at 85.47 intraday. It didn't take from down here to up here in less than 2.5 weeks, 3 weeks almost. Boom, we took off. So what we know is when you get in the green zone like this, then volatility and hedges are very cheap. And you want to be a buyer of hedges right now because it's very cheap to hedge your portfolio. So I'm getting our members hedged up. And just if, especially those that are carrying larger position sizes, you want to hedge up because puts are cheap right now, or cheaper than they've been in quite some time, because we're at 1383. All right. So that's just a little bit about where I'm seeing the action here on this, breaking this movement. Hang on 1 minute, guys. Sorry, back with you. So if we come down here and look at interest rates, I think rates are going to pretty much run higher and stay higher for longer.
which means the bonds are going to go lower. And if we look at bonds, they're probably going to come down. We're in the green for the year with bonds, but I think they're going to come down and test the closing price of last year and then come down and test the 2023 lows. That's how I see the bond market playing out. Interest rates neutral, bullish. If we look at the US dollar, it's going to stay bullish. Hang on one second, guys. So what we're going to see here is, I think we're going to see another rally in the dollar, one final rally, and then it's going to roll. So I'm waiting for it to have a final rally and then roll, and we're going to want to go along the euro. We've had 2 setup trades in the euro this year, and we've made really good money on it. My target for the euro was originally 1.1167. We came in 1.1121, so we came in fairly close. You can see the way the Elliott waves are setting up is it suggesting a small rally and a rollover. But remember, the euro runs opposite of the dollar. If we do run into a recession, the euro is going to go lower, okay? And the dollar will go higher. And then we're going to want to look for a good entry signal in the euro to be long, or you can short the dollar if you have access to trading the dollar. But that's kind of what I'm seeing right now in the currency market. And of course, if we come over and we look at metals, we look at gold, it's not going anywhere as long as the markets are moving higher. All right. Money doesn't want to stay in gold on a bullish market. We just don't see it. You can see how it's just flat right now. It's testing the 50 EMA up and down. We've been bullish gold earlier this year and over on this run here, but I was having everybody get out of gold back over here in early April. Okay. Which turned out to be an interesting trade where you could pick up some money pretty quick. But gold, I would not want to play it long. Same thing with silver. Copper is another one. I think I pointed out to you guys here in my weekly blog. You can see this regression channel. Copper doesn't stay north of the center line of this regression channel very long. I think the 50 is going to cross over the 200 again. I think the odds favor a little bit of a push right here and then a roll back over. That's kind of how I would see this. Remember, if their economy starts to falter even more, it's going to put downward pressure on copper because copper, pretty much its movement reflects to a large extent where China goes, right? And you could see China had this big move up right here was when China announced their zero COVID policy coming to an end. So the world markets took off, including copper, because it follows China very closely. But then when economic data started coming out where it wasn't that good, then you can just see how copper reacted over a longer period of time. All right, if we do have a recession, copper is going to go lower, and it'll set up for a nice long play. Oil is another interesting story. Even with OPEC +1 talking about cutting production, oil is more prone to run sideways to slightly down short term. Okay. I think Russia is doing everything they can to skirt some of the OPEC rules and pump as much as they can because they need money to fuel their war efforts. So, and there's always someone willing to buy on the market. So that's kind of where I see with oil right now. We got a really good way to trade this. Members, we'll talk about it again in our Sunday night weekly market watch session. Intraday, oil did move into a bear market this year, but you could see it was probably a squeeze here is what happened. Came all the way down, and then it just people that were trying to get long oil here, and they squeezed them out of the trade, and then here we go. So this is a little bit about what I see about oil, nat gas. I have my favorite trade that I really like with nat gas down at this level. I don't think it's going to go much lower than this, nor do I think it's going to go much higher than this for this year, unless we get some kind of geopolitical change. But outside of that, nat gas is just running this way, and we've got some really interesting ways to play that kind of move in the option market on those futures contracts. All right, everybody, that's kind of where we're sitting right now. Everybody, I will see you next week. Well, next weekend is a holiday weekend. Monday is a day off for the markets on June 10th, I think. So I won't be doing the blog next weekend. So make it a great long holiday weekend, everybody. Members, I'll see you this Sunday evening at our normal time for our weekly market watch. Ciao, folks. Bye now.